Hello, everybody. Welcome to this week's episode of the Weekly Wrap. This week is episode 10. And, this week we're kind of looking at another rally in the markets. There are cases to be made, whether it's a bear market rally or something that could lead into a more bullish move. And we'll get into that in just a minute. I just want to go ahead and say if you like this type of content, every week and every weekend, I'll say we release this type of video where we go more in depth and have some more commentary on the markets from the week prior. And then every day that the stock market is open, we do have a short video that comes out that day. So if you enjoy this type of content or anything I said interests you, be sure to subscribe here on YouTube and follow us wherever you listen to podcasts. But let's get right into it. So we saw some rallying in the market this week, even though that the Fed came out and was talking about how they were going to continue tightening the economy and that it would have probably a painful consequence for the economy as a whole and markets. And they went on to say that they were going to keep raising rates and keep them high until inflation came down to their 2% target. And that will probably take a long time. So they were saying that the markets really haven't priced that in, they don't think, the real consequence of that. And markets decided to rally anyway. So it was a really interesting week. And let's get into it. So as far as the outlook is looking for bulls and bears, we've been taking a look at this chart on the channel, and obviously we have on the bull side some correlation with 1962 and 2015. So what happened in those years is we had a rally like we're in right now, still kind of like a continued rally. And then we came back down to retest the lows. So for us, that would mean coming back down, testing those June lows, and then either kind of trading in a range for a little bit and then moving higher, or immediately starting to recover. And right now there's a high correlation with those markets. On the bear side, however, obviously a lot of people are pointing to these two markets, 2008 and 1973, the 70s. This because of just like the general economic collapse and unraveling that happened as the housing market does look weak right now. And 73 because of the inflation problem that was happening. So in these markets, the rally that we are seeing and the rally that we saw then was really correlated with just the bear market rally. And these markets then continued to sell off. I will say that in both of these markets, we did not recover 50% of the losses from the low points. And in June we did. So in June we hit a low, and since then we have recovered over 50% of those losses from the peak to the June trough. The only time that's happened in an index, and we did not recover, and that was not the low, was in the Dow Jones right before the Great Depression. That was the only time that that 50% recovery has not been an indicator of a low. So that's definitely something to keep in mind. Obviously, every market is different, even though that they're correlated, but that is something to pay attention to. I do think there's definitely probability for either of these situations to happen for bulls and bears, so I definitely want to talk about them both. I don't think a housing collapse would be as bad as 2008, and also if the Fed does their job, we shouldn't have sticky inflation like we did in the 70s and 80s. There's multiple reasons for that. Obviously, that the Fed has referenced, Powell has literally referenced the Fed chair from the 70s and 80s, and he's cautioned against pivoting too early like they did then, which caused inflation to be higher for longer. So if they do their job, inflation shouldn't be sticky, and obviously we are just in a new era of technological advancements which are inherently deflationary. We talked about that a little bit last week. We watched some videos from Kathy Woods, and she was talking about how we've never seen an acceleration of technology this fast, and it's only going to continue to be getting faster, and that in of itself is inherently deflationary. And if you look at a heat map, I should have put this in the video, maybe I'll do this next week. If you look at a heat map for inflation, If you look at the sectors that have technology disruption in them, they're actually deflationary even for the year. Their prices have been going down. Things like televisions, computers. I'm trying to think. Just other things that have a lot of technological growth in them. To actually see prices come down, and inflation is really only in the areas where we haven't seen technology penetrate yet. And she thinks, her whole thesis is that technology will penetrate all of those sectors of our lives and will inherently be deflationary. So that's also something to look at. There's not really any hard proof for that, which is why we're still looking at these markets, but it is something to keep in mind as economies and markets are always changing. So as far as retail sentiment goes, we have hit a low point since June for the year. We're at a record low for bullish sentiment and a record high for bearish sentiment. Usually when things like this happen, especially in the retail market, that's usually when markets get pushed around as institutions like to capitalize off of the retail investor. They like to trap them for liquidity. So even though the outlook could be bearish from a fundamental standpoint, if too many retail investors are feeling bearish, the markets can definitely move higher, which is kind of what we've been seeing now. And usually you'll see retail sentiment basically just following what the market does. So if the market makes a big move lower, there's a lot of bearish type of news coming out. You'll see the bearish sentiment growing and the bullish sentiment shrinking, and vice versa. If you see big bull moves on the markets and you see a lot of articles coming out talking about, oh, we're headed for all-time highs, things like that, then you'll see it flip and you'll see a lot of bullish sentiment in retail and a lot of bearish bearish sentiments shrinking. And generally, smart money does the opposite of retail sentiment. And is kind of more forward-looking than just looking at what's happening right in front of your face in the markets. So I do think that this is an important thing to track because you can really kind of predict what's going to happen in the markets if something gets too out of hand. So when bearish sentiment gets too out of hand, you can expect a bullish move coming. So as far as institutional hedging, they also were getting a little bit bearish. So we had a record amount of puts being opened, protective puts, on the institutional side. So if we take a look on the left here, it was a record amount of put protection in the markets as we kind of made this leg higher, and then the Fed had that Jackson Hole event. They took out a record amount of insurance basically on their portfolios. And if we take a look at the sentiment over here, this is basically just a blown up version of this chart along the bottom. Last week's panic hedging was 3 times more extreme than in 2008. So especially when you see everybody going bearish, retail investors and institutional investors, everybody's going super, super bearish. I mean, this is a record amount of bearish sentiment on the hedge fund side. I mean, the markets can't pay everybody out. So they can't pay out all these puts at a huge premium for everybody. So the market has to either stabilize in a range or go higher, because that's just the way that markets work. Everybody can't be right. So I do think that that's something that can push the markets higher as well. It is also a little bit surprising for me to see. I think they kind of were panicking after that Jackson Hole event. Obviously, the Fed has a lot of power when it comes to pushing around markets. And I think they're expecting a huge move. We did see a big move following the event, but I think a lot of that was due to the huge move that we saw to the upside before the event. Obviously, we do know that over 50% of the losses from the high to the June trough were breached. And generally, that's a bullish signal. But obviously, in this market, I think a lot of investors were expecting that we hadn't seen the worst yet. And especially after that speech, they're expecting a bigger move to the downside. Now, I do think we have to remember that even though we're in unprecedented times and it does look really, really bearish around the globe, markets are generally an outward-looking mechanism. So even if we're expecting situations and economic situations to get worse through the winter, especially in Europe, with Russia cutting off their gas pipeline. Obviously, Europe is having a huge energy crisis. People are having way bigger problems over there than we're having here in the United States. And that's expected to get worse. It may have been priced in. I'm not saying that it was priced in. I'm not saying that things can't get worse. I do think that things can get a lot worse than we're expecting in Europe if Russia doesn't turn the gas back on. But generally, this is a forward-thinking mechanism, and generally it overreacts each way. It overreacts to the downside and overreacts to the upside. So let's say that we didn't even quote-unquote price in what could really go wrong in the winter time in Europe. Well, maybe we overreacted to the news that we had already had and we're pricing in. So I do think that you have to be careful going one way or the other, getting overly bearish or getting overly bullish. So if we look at this indicator for an oversold, which basically just means that the market's overreacted, we obviously breached way above that level in the COVID crisis. I think a lot of us didn't really know what was going to happen. That was a really, really scary time, obviously. We didn't know how a pandemic was going to affect our economies. So I do think that maybe this was justified, but from a fundamental standpoint, especially looking back in hindsight, we were way oversold. And we reached the threshold in June. And we saw a rally after that. So even with the markets moving back lower to the downside since that Jackson Hole event, we really aren't anywhere near this oversold territory yet. So I do think we have to be careful. Again, I'm bringing in both sides, bearish sentiment or bearish thesis and the bullish thesis. We do have to be careful thinking that just because we're getting back down to these levels doesn't mean that we're oversold. There's been some time that's passed, and so the moves lower can be more justified. So I do think that if we see some capitulation in the markets, that this level could be reached again. But as of right now, we're not there. We're not anywhere near it, actually. So obviously when it does move up, so we're at the level that we were here back, I believe this was like November, December of 2020, and we saw these huge corrections in the market. We reached the same level we're at now. But as far as like a real bear market goes, we're not anywhere near being oversold, anywhere near where you could say, hey, the market's pretty cheap and there's not a lot of risk left to the downside. We're not there yet. So let's take a look at smart money versus dumb money. I really, 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 really love this indicator. Generally, you can get a lot from it. So smart money's in blue, dumb money in brown, red, whatever you want to call it here. Last week, we saw a huge divergence between smart money and dumb money, where we saw a lot of smart money coming into the markets and a lot of dumb money leaving the market. And that's when we are around this low right here. And guess what? Since then, we moved up. And now we're not quite there yet to them crossing over, which is generally when you want to be really, really cautious one way or the other. But we are seeing smart money kind of slowing up as the markets are moving up now. And we're seeing dumb money kind of coming back in. Generally, you'll see, just like in general retail sentiment, dumb money kind of basically just moves with the market. So if the markets are moving up, dumb money's coming back in. If the markets are going down, dumb money's leaving the markets. And generally, you'll see the opposite from smart money. If the markets are moving up, smart money will kind of slow up. And if markets are moving down, you'll see smart money coming in to buy up those lows. And we're kind of moving back up in the markets, and smart money saying, okay, I think I can maybe get better prices in the future, and it's starting to leave the markets. Whereas dumb money's saying, oh, I don't want to miss out on what could be a huge, huge rally. I'm coming back into the markets. So we do see smart money still above dumb money as far as inflows go in the markets, but we are seeing kind of a change of trend a little bit, and we'll have to keep an eye on that. If the markets continue to move up, I do expect that these will meet once again, and that's when you could expect really kind of like those violent pullbacks, especially in a bear market. So let's take a look at the bond market. So the bond market can definitely be an indicator as far as recessions go. It's very good at predicting a recession before it happens. I do think we're in a recession right now, and I think the reason why it doesn't show it here, obviously the United States has not recognized that we're in a recession yet because of just political things that are happening here, but it has been a very, very good indicator. Pretty much any time over 50% of, well, this is at 55% of yield curves being inverted. Pretty much any time you breach this level, there's a recession that follows. And we started seeing yield curves get inverted as early as the beginning of this year, late last year. And now we're over 55% of yield curves being inverted on the bond market. And so that really signals that there's a recession incoming, or that we're in one right now and it'll be continued. I do believe we're in a recession already. I've been saying that for quite some time. And this is just something that goes and kind of backs that up. So I don't really look at the bond market too much, but I do look at the yield curves. I don't like investing in the bond market. I guess it's just kind of been a safe haven because the government will always pay you back. The U.S. has never defaulted on debt. But to me, I don't really see the United States continuing that. I do think we default on our debt at some point. I think since the Bretton Woods agreement, since we got off the gold standard, I don't think that it's going to work. Like, people don't understand that fiat money in of itself is an experiment. We've only been working with fiat money backed by nothing in the United States since the 70s, since Nixon took us off the gold standard. It's not something that's been around for a long time, just this paper, valueless money. It's an experiment, and I don't think it's going to work in the long term. I think our debt is spiraling, and I don't think it's going to work out, so I don't invest in bonds. But the bond market can be a good indicator for what's happening in the general economy, and I think that this is really what I like to look at, and it is because of how well it is predicting a recession, and we've reached that level now. So as far as volatility goes, I've seen this chart circulating, and it's the VIX in white from 2022, and it's overlaid with the VIX preceding 2008. So obviously they look correlated. I think a lot of markets in the VIX can look correlated, but I think it just goes to show that you really don't see the end of a bear market till you see the VIX really go parabolic, generally around the 45 to 50 level. Obviously in 2008 it was worse because of the violence, the velocity that we had in that crash, that collapse. But I do kind of agree somewhat with the sentiment that goes along with this chart. I do think that in order for us to truly hit a bottom in a bear market, I think that we'll have to see the VIX go higher, and we'll have to see more capitulation in the stock markets. And we haven't seen that yet. So I do think there is a reason to be a little bit cautious. There have been a lot of calls being opened on the VIX, and I do think that can be something that can keep it low for a little bit longer. I think when those calls expire, you might see a little more volatility come in. I don't necessarily think that this bear market is going to be like 2008 in its extreme, but I do think it can get a little bit worse than what we've seen, especially in June. I think we haven't really seen that complete panic and that general sentiment from the markets of, oh God, what's going to happen? We haven't really seen that yet. So maybe that happens in the wintertime. Maybe that happens sometime even after that. As we'll take a look at right here, we're not really anywhere near the averages as far as bear market length and bear market declines. So we took a look at this last week, but I think it's a good reminder that this tracks every bear market since 1835. And the median is really what I like to look at because you can kind of get rid of the extremes that get priced into the averages. So the median length of a bear market is 18 months, and we're not near that. We're in month 9 right now of the decline, not even since we've been in a bear market. So there is definitely still some time as far as the average bear market goes. The average decline is 38%. The median is 32%. Right now on the S&P 500, we're not even at 20. We're at like 16. So that would suggest that we're only halfway to the bottom as far as the averages go. And then the peak to the trough is about 14 months. So the peak of the market, which was January, to the trough, which would be the bottom, is typically 14 months. And if June was the low, that would only be a 6-month peak to trough, which would then correlate with, hey, we're about halfway through this bear market, as with the 32% median decline. And the trough to recovery is about 11 to 13 months. So obviously, I don't think we've seen the trough yet, so I don't think that we need to worry about this column yet. But if we have, generally 11 to 13 months, you get back to the all-time highs. So this definitely suggests that there's some pain left in the markets. There's a lot of history, obviously, in this chart. It goes all the way back to 1835. So I do think that it's worth putting a little bit of stock into, no pun intended, but I definitely think it's something you have to keep in mind before you start getting overly excited on the markets, saying that they're on their way to the recovery. So obviously, we've been looking at trends as far as just generally in a year. So this chart tracks S&P returns through September, and it's from 1950 to last year, 2021. And generally, we do see some trouble in the end of September. And we'll see in just a minute, this is definitely correlated with a midterm election cycle. But we do tend to see late September that trouble start to creep in. Right now, today I'm recording is September 10th. The markets will open on September 12th. So we'll open up here on the markets, and it would even correlate with this bull rally that we're in. We could see a little bit of rallying left to go. And then say week after next is when we could start to see some trouble as far as the trend goes from 1950 to last year, 2021. And when you start to see these synergies in the markets, I like to talk about the synergies and the indicators. When you start to see those, is really when you need to start keeping an eye on it, because then it's not so much an outlier as far as we really need to pay attention to this. There's a lot of different indicators flashing. So this tracks midterm election cycles. So through the beginning and middle of September, you do see the rally typically in a midterm election cycle. This goes all the way back to 1931, which would correlate even what we're seeing in real time in the stock market. We're seeing a little bit of a rally. And then late September through October, you'll see kind of the steep decline, which we definitely could see. Say we breached the June lows during that time, and then maybe we stabilize. And usually November, December is bullish anyways, but it's especially bullish during a midterm election cycle after the election. After there's that uncertainty is gone, is when you see the markets start to rally. So I do think that all that uncertainty in correlation with everything else that's going in the markets could send us lower. Maybe we breach the June lows. Maybe we revisit the June lows, and then we stabilize and rally from there. Everything is kind of lining up. So I definitely think it's something that you cannot ignore. So I do want to take a look at what happens once the 200 moving average is breached above. Obviously, we've been talking a lot about how we're below the 200 moving average. We've been keeping an eye on it since we breached below on the daily, because that's a really big indicator of bull and bear markets. But this is generally what happens once we break back above. So typically there's a huge rally. Obviously here there's an exception, but usually there's a big rally. Here's another exception. But usually there's a big rally, especially when you've been under for a long time. So I just want to reiterate that this is what I'm going to be looking for, really. Obviously, we have our trend line on the S&P 500, and we'll take a look at this in just a second. But there's a lot really to pay attention to as far as when this bear market is going to end. And this is something that I like to keep an eye on for sure. So let's take a look at Apple. This is the biggest company in the S&P 500. It really moves the markets around, moves the technology index, moves the growth stocks. And they just had their big event for the year where they revealed the iPhone 14 and a lot of their new products, new watch, new headphones, all that stuff. So it's been coiling. We had this level drawn out after we broke through our trend line that was through here, and we breached through this level. We hit this resistance at the top of this zone and sold off, and we knew that this would have some buying support. So we're sitting right near the top as of right now. Obviously, if we break back above, we'd be moving back towards this resistance line and maybe even this trend line here. And if we break below, we're headed back towards kind of the 138 level to the 125 or the 135, excuse me. And from there, the June lows. So I really like to keep an eye on Apple because it's a really big indicator as far as what the market's going to do. So I like to look at it here on the channel, and we've been able to predict it quite well so far. So we did take a look at Cathie Wood and her flagship fund for ARK Invest. She claimed that her stocks were bottoming, so I thought I'd take a look at it today and see what happened since then. So Her flagship funds had a lot of trouble with this 50-day moving average. It hasn't really been able to sustain above for a while, and right now we're approaching the 50, and we're approaching it kind of as a resistance. It's bounced off a couple of times before, but one thing I do want to point out is that the 50 moving average is kind of flattened, so we're kind of now in this range on her style of stocks, these like hyper growth tech stocks. I do think that it has a place in your portfolio, a small allocation, especially now with how low they are. I do think that they should have a place in people's portfolios, especially if you have a really long time horizon. I do think that they can solve some of the inflation problems that we're having if technology does penetrate into new sectors. So I do think it's something to keep an eye on, but right now it's sitting at a resistance at the 50 moving average. So let's take a look at the big kahuna now, the S&P 500. Obviously, we had that huge summer rally from the June lows through July and into August. We bounced off the 200-day moving average and the trend line that we had drawn out, and we sold off, and then we kind of started to buy up, and the Jackson Hole event put an end to that. We had a sharp decline. We came back to this zone that we had mapped out, and then we breached through the 4,000 level. We breached through this zone, and now we're bowling higher. So first impressions, honestly, is we have a low, a higher low, and then a higher low again. So that in of itself is bullish, but there's a lot of things stopping it from breaking through this trend line. Obviously, the whole geopolitical situation, the economic situation here in the United States and Europe, it's hard, I think, for the S&P 500 to break through this and go to all-time highs. But we do have to keep an eye on it because it does. I mean, it looks bullish. It looks more bullish than it has through this decline. So it is something to look out for. But what will stop it? I think this zone will stop it. Here, we've had some trouble here before. I think the level we were at, even though it's not really a distinct level on the market that sold off for the Jackson Hole speech, and then obviously if we make it all the way back up, this trend line will be really hard to break through, as well as the 200-day moving average, and they're kind of in lockstep right now. So I do think when we break through the 200-day moving average and this trend line, that'll signal the end of this bear market, at least for now. But I wouldn't be surprised if we see a little more buying. We maybe get to the top of this zone and then sell back off pretty sharply, because that would kind of go hand in hand with everything else that we were seeing, especially with sentiment and things like that. So that's what I'm looking at on the S&P 500. Obviously, a lot of that will have to do with Apple and what it does. It would make sense for it to kind of bull up with the market here and then sell off, but we'll just have to see. And Bitcoin. So Bitcoin had a huge day yesterday. We went from like 18,000 to 21,000. It was a 10 to 11% move on Bitcoin. So we started the day really high, and we've kind of rejected the top of this zone at the 21,200 level. So Bitcoin kind of sitting there. I wouldn't be surprised if it's sold back off again. Usually after a huge move on Bitcoin, especially in this range we've been in, we kind of see it sell back off. And we do know the importance of this level. So it bounced off this level very strongly. There were a lot of buyers here. But will there be more buyers if it heads back down into it again? We'll have to see. Obviously, the 17.5 to the 17.7 level is the point of no return. If we break through there, there's really nothing stopping it from it getting back to 11,000 if we break through there. That's why that level is so big, why I have it mapped out. And I do think we're in this really elongated bear trend for Bitcoin. So there's nothing really to point to say that we're out of that yet. Obviously, the U.S., they released a statement a couple days ago where they were weighing the impacts of Bitcoin mining. They had some negatives in there, but they did say that it could help ease a lot of our problems with the grid. It could help with climate change here in the U.S., and there was a lot of positive things around Bitcoin mining. I do think that's interesting because I think in the end, the U.S. is going to want to roll out their own version of like a USDC where they can monitor and censor everyone's money. That's one reason why I'm super bullish on Bitcoin, is because I don't think the people want that. I think that Bitcoin really gives freedom to everybody as far as money goes. Governments can't censor it or seize it, but they can when they roll out their own version of a crypto for our own fiat money. They'll be able to see all your transactions at all times. They'll be able to censor your money, freeze your money, take your money whenever they want without your permission. And that's just one reason why I keep trading out my US dollars for Bitcoin, is because I would rather own Bitcoin as a store of value, as a way to save money, as opposed to putting it into US dollars, because one, I don't trust the government, and two, I don't want them to be able to see all my transactions when they convert that to a USDC. And I don't want them to be able to censor it. I want to be able to have my own opinions. I want to be able to lead my own life and not have to worry about the government taking my money. So aside from that little rant, I'll kind of end it there. We're kind of in the middle of this bear market rally, or are we in the markets? We'll have to see. If you enjoyed this video and you enjoy this type of content, be sure to subscribe on YouTube and follow us wherever you listen to podcasts. Be sure to like the video, and stay tuned. Next week, we'll have new episodes of the Daily Dose coming out every day that the stock market is open. And until then, I will see you next time.